Good morning. We will call to order the March 10th meeting of the Other Post-Employment Benefits Trust. First item, I'm sorry? The May 12th, I'm sorry. May 12th, I read the wrong date, sorry about that. May 12th, I'll move back 1 month. The first order of business is the approval of the minutes from the March 10th, 2014 Opebt meeting. Any motion? All in favor? Aye. Any opposed? All right, the next item is to receive the monthly investment flash report for March 31st and the report for April 30th. And Greg Weaver is here with Gregory W. Group to present the information.
Sure. Thank you, Chairman. Appreciate that. I am here in Doug's absence. I shared with a few of you individually that he said, hey, a brand new baby at home. And on the more serious front, his mother had a massive heart attack about 2 weeks ago and came out of her coma on Friday. So he's been distracted, and I've been here all weekend for a family wedding. Said I'll be happy to come to Oklahoma City. Hi, Laura. So happy to be here, and I hope I know the answers to everything. We have a good team. You've met Colin Cornell, has been with me about 6 years. Tony Kay, nearly 10 years. I hired Doug in 1991. And I've been in the business for over 30 years. So we all work on every relationship that we have, every client that we have, whether it's here in Houston or Dallas. We all four know what's going on almost every portfolio. And some of us are more of a lead consultant and day-to-day than others on certain relationships. But we have a great communication, and together we work really well together in terms of experience, thinking, different ideas, different decades of generation of experience. So we're going to talk about your portfolio and what's good, what's bad, what's ugly, what's happening in the markets a little bit. April was a better month for your portfolio. The total assets you can see on the second page on the flash report for the April 30 is $29.112 million. So you did see some positive improvement for the month of April. And we're very, I guess anxious is a good word, about what will occur throughout the summer in the marketplace. So this is a good number for the month. What's extraordinary to me is you look at the March 31 data in just a few moments, then you look at the April 30, and our eyes are always drawn to, the total market value. But then you look at each manager, and the relative rankings of each manager is a very dangerous statistic in that it misleads you sometimes to a reactionary decision of whether someone's performing very well or very poorly. Fayez Serafin is a great example. If you look at the March 30 in a few moments, they don't look good relative to their peer group. The ranking's around 90th percentile, which is towards the bottom. However, if you look at this particular page in April 30, they're in the first percentile. Now, that's really irrelevant other than over a long period of time. It's important that we know how these managers are performing against peers. And peer group in our world is very, very different as well. So one could look at the March 31 and say, I'm not happy with Fayez at all. Then here we are 30 days later, and they're in the first percentile of the relative peer group. So that's just another indication as advisors, as we counsel with folks like you and funds like yours, we have to step back and say, as a committee, as fiduciaries of this very important fund, what really matters? Is it that we did beat our benchmark? Is it we outperform our peers? Or is it we're accomplishing what we want to accomplish, which is what, 5%, I believe? 4.95% is what really, really matters here. It's not how you do relative to the rest of the world. So I want to make sure we have that, and I know Doug espouses this all the time, that if it's a defined benefit plan, what really matters? It's your actuarial assumption. You're in the same situation. You have to get that 5%. If that changes through this leadership, then we'll adjust the portfolio slightly accordingly, whether it goes down or it goes up. We have pension plans that have an earning assumption rate of 6%, some have 9%, some have 8.5%. So it's a different portfolio construction to make sure that's accomplished. And yes, with your equity exposure, we want these earnings to start growing for the compounding effect. You have a very long-term structure. In effect, this fund's perpetual, right, with your unfunded liability. So it's not designed to perform month to month, quarter to quarter. But year after year after year is what really, really does matter. And I don't care what our experience level is in the world of investments and securities. It's so dangerous to look at all these day to day, week to week, and month to month. Although we have to as fiduciaries. But be mindful that the structure should work over a long period of time. Any questions on the April? We can go in a little bit more depth here in just a moment on the March 31. Good. I think we did distribute our bound copy. It's in a green cover. That is a little bit easier to understand because of the color coding. So let's step back to March, and we can look at the market, what's happened so far in May. It's been a pretty good 10, 12 days in the market. Summer is an interesting time in investing, and I was in a meeting on the East Coast last week with some fellows from New York and Boston and Chicago, and they said, summer, everybody leaves. They just kind of go to the Hamptons or they go wherever they go. So the summer is kind of an interesting time in the markets, and we have to be very patient as to what may occur. It's been a great run for most of us so far. You look at March 31, and the way this is color-coded, of course, is the green as you go down the month, last year, 3 years, 5 years. On the left chart is the equity components, equity indices, if you will. And this changes day to day, week to week, month to month. You can look at charts of this for 20 years, and it just goes back and forth between small cap, mid cap, large cap, value, core, growth, etc. So we have to have exposure to most of these colors, if you will, most of these indices if we possibly can. There's some of these, in our opinion, we don't want to have much exposure to right now, and what would that be? The very last line is emerging markets. And your exposure with your new manager, Causeway, they only have 3% emerging market exposure. We like Causeway, and we did replace Thornburg with Causeway because of their stock selection capabilities, and they invest in emerging markets opportunistically. So it's not we have to have 20%, 30%. As they see value in emerging markets, they'll go there. But it's not without peril. It's not without high volatility. A lot of public funds across the country are chasing emerging market debt and emerging market equity because they're low valuations. And it's not for the faint of heart. But as a long-term investor, it may make sense at some point in time. But today, they're very, very cautious. You can see the returns between the various parts of the market. Well, I always have the discussion, have for many, many years, about why should we just not index everything and forget it. Well, what do you index to? You can see here the index funds, the S&P cap-weighted, equal-weighted, are different in their structure. It's all, of course, all these are structured indices. And as you look down here, you see these Russell indices. The June 30th of every year, Russell Investment Group in Tacoma, Washington, restructures the Russell indices. They manage what these are. So they take some stocks out, some stocks in. So it just rotates every June 30. So even these indices, as we review them, aren't consistent from one year to the other. And so we have to be mindful of that. And then be mindful, if you look at Stevens in just a few moments, how do they compare to the small cap growth indice? Does it really matter? If you look at Fiserv in a few moments, how they're structured and how they deploy assets is so much different than the Russell 1000 growth indice in which they're compared to. If you look at Delafield in a few moments, they're truly a contrarian manager, and to compare them to some mid-cap index is completely almost unfair, but we have to compare them to something. So as an investor, you can see where you want to have been and what has happened, and what do we learn from this chart? Diversify it, stay static, don't try to react to what's been the best performer and go there, and don't fire what's the worst part of the markets have been, is a chronic mistake. Upper right-hand side is the bond indices. It's been a real challenge for many bond managers to outperform the Barclays Ag in the last few years. It's even more of a challenge, in our opinion, and Doug and I spoke about this early this morning, about what's going to happen when rates really do turn for real. These bond managers are going to have a real challenge in being able to protect what they have, because the sensitivity that they will have with their maturity duration strategy versus a rate cycle, which it will one day, and we said this 5 years ago, it will go up, hasn't happened. And the leading people that we follow and read and speak to about this don't think it's going to happen for another at least year to 2 years in terms of a serious rate increase. And we'll see what the Fed does. We like the new Fed leadership very, very much. We think she's extremely intelligent. She's extremely transparent. And the market has a much better sense of what the Fed policy will really be, in our opinion, with her leadership. So one of your challenges is you're concentrated with 30% of your portfolio with J.P. Morgan Core. They're a solid manager. They're a very conservative manager. They've done a good job. Not okay job, they've done a good job. It's our thinking to consider in the future maybe diversifying that piece a little bit. Because when rates do turn, there are firms that we do deal with and know of that, in our opinion, are probably better able to react to a rising rate environment. because with 30% of your fixed income, if they can't do a better job at managing credits, they're going to have a potential for a large loss. All core bond managers are. And some are in a position to protect you more than others. We're not suggesting you lower your fixed income exposure, but we're suggesting you manage it a little bit more cautiously and carefully, and maybe more diversification in the future. And it's a real challenge for all public entities. Some have reduced their exposure, but the question is, if I come out of fixed income securities, what do you do with it today? Where do you go? You know, the equity markets are volatile. They've had a great run. Where do you turn? So a lot of product managers on Wall Street are promoting a lot of fixed income substitute products, which we know some of those, but we have to be very cautious. On the next page 3 is a very simple graphic of the portfolio returns relative by asset class, domestic equity, international fixed income composite, and the actuarial assumption. Be happy to dive into any other areas that you want. Page 4, this is always helpful. I'm glad Doug and Colin created this chart to go back to fourth quarter of 2009 when we started the relationship with the city in terms of what's happened. We started with you a really tough time in 2008 and 2009. You've made some terrific changes in diversifying the equity exposure, but it's not been without some volatility. The annualized returns on page 5, you can see versus the actuarial assumption. The second column is the fund in the gray. And remember, I'm sure Doug continues to go over this with you, but the allocation index and policy index are different. The allocation index is your exact weighting of debt to equity in the markets versus what the markets would have done all index fund. The policy index is exactly what your investment policy says it to be. And they should be pretty close, but yet there is a difference in terms of the actual weightings. And it gives us a little better handle of, are we close to our policy? The allocation index close to policy, and is our policy still appropriate? On page 6, these are some of the things that we've done for you in the past. Slight negative return for this quarter we'll get to in just a moment. We think you made some great decisions in the American Funds Growth Fund of America going away, and we like the diversity among the Dreyfus Appreciation, Delafield, and Stevens. I'd be challenged if a dear friend came to me and said, I have $10 million and I want to invest it with one manager. It would be interesting and not advisable to select just one of these 3 managers. But how they work together as a group, with Dreyfus Appreciation coverage in the mega cap, large cap growth space, Delafield in the mid cap value space, contrarian oriented, and Stevens in the small cap growth space, high quality small cap growth companies. How those correlate together and work in different environments is a nice structure. But usually they're not standalone entities for all of one's assets, and that's been intentional on our part. As I said, thank you for replacing Thornburg. We have them in many other relationships. I've spoken with Thornburg. They're still not doing well. Causeway, Harry Hartford, and Sarah Ketter manage Causeway Capital in Los Angeles. We've known him for 20 years. Harry Hartford got his PhD from Oklahoma State, and Sarah Ketter goes way back with the whole Hotchkiss and Wiley team. They're a terrific, independently owned, very, very globally well-known international equity manager, and we think you're going to really enjoy their experience of what they're able to do together. Not without volatility. From time to time, they're a little out of favor, but their long-term record is absolutely extraordinary. I share that with you to say that Doug and Tony and Colin and I have access to the actual people who manage these assets. In the mutual fund world, it's hard to really get to speak to the person who really manages the money. And one of the things we bring to your table and other clients is we have 23 clients and about $17 billion under supervision. So we have a lot of money with a lot of managers, and it gives us access to the key players to really call Harry and say, tell me what's going on. Sarah, what's going on? Talk to Ryan Crane at Stevens to know what's happening. So it's our job to know these deeper than what the numbers show and what some mutual fund report will tell you. We think that's a value add. On page 7, you know your equity exposure has increased enormously since 309. I've always said, we'll say to every client, every meeting, every time you look at this, you need to step back and say, okay, if I had to start again with $29.112 million today, How would I deploy it differently? Should I? Should I just stay with what I started with in 09? Hey, you change it in 11 and 12. The only thing that should change that is if your earnings assumption, the 5% has changed, your funding has changed, your demographics have changed. Otherwise, if it was a good long-term plan then, it probably is now. But those are the fundamental things that should change what your allocation might look like. The following pages, the individual funds, I've spoken generally, fly over about the strengths, the philosophy of these various fund managers. There's a lot of data within these fund pages. We think it's very important as a public fund fiduciary to have received this report from us, that you've noted how they're deployed, what their weightings are, what their philosophies are, what some of their holdings are, and whether anything's changed within the organization. J.P. Morgan, as you can see here, has done a solid job. They're a very middle-of-the-road player. You can see on the key characteristics that their fund duration relative to the Barclays Ag is very close. What's that mean? That they're an interest rate neutral manager. They're not betting on the direction of interest rates. So they're very cautious. They're very defensive. But their value add has been their ability to be in the right sectors of the fixed income market and make good quality security selections within various parts of the bond market. So at 57 basis points for the amount of assets you have, at 8.7 million at March 31, that's a competitive fee, and the results have been acceptable. As I said earlier, Doug will talk to you more about this in the next meeting or two. Consider diversifying that a little bit, just to protect that a year or two from now when rates do turn. Dreyfus Appreciation is a love-hate relationship. It is managed by Fires Seraphin down in Houston. That firm's been around, I think, he's been around since 1958, Fires himself. It's a family-owned business. It's been extremely stable through the years. It's a very extraordinary portfolio. The best thing about this portfolio is two things. One is, out of their top 10 holdings, right, 7 of those holdings they've owned for more than 15 years. Their annual turnover ratio averages 5 to 7%. So they buy a stock like Coke or Pfizer or the largest companies, global franchises in the world, and they don't sell them. That's cash flow, global stability. That's also a dividend. Right now, this morning, it was 1.63%, higher than the S&P dividend. So extremely low turnover, global dominant franchises, and very low turnover, which, in our opinion, for a long-term investor is a terrific opportunity. And you're able to purchase that through the Dreyfus Mutual Fund family, which I'm glad you did. You can see the different characteristics. I referred earlier to the performance page, the middle of page 9. You see the ranking 88th, 95th, 83rd. And you go, goodness, that's not too good. That's in the bottom quartile relative to other managers like them. The reality is there's not other managers like them. If you look, for example, at the weighted average market cap, the Russell 1000 growth is $49 billion. Look at Dreyfus Appreciation. It's more than double the median market cap of their benchmark. The biggest global dominant franchises on the planet. The turnover ratio is 6%, only 65 names. So we think that will do the job long term in terms of having large mega cap growth exposure with global emphasis. I think I read recently that Dreyfus Appreciation, the average company in their portfolio, over 65% of their revenue comes from non-U.S. sources. So that's globally dominant if you think through and look through their top holdings. Delafield's on page 10. Again, this is a firm that was brought into your portfolio not that long ago. Delafield, as you know, is owned by Tocqueville Asset Management, which is a French holding company, but they are headquartered in New York. We've had assets with Tocqueville/Delafield for quite some time. Mr. Delafield has been in this business for years. He's in his mid-70s, and he and his partner have done a terrific job of buying stocks that really none of the other street even wants to look at. If he sees a stock that every broker on Wall Street says sell, 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 he goes and looks at it and goes, let me take a look at the valuation on that. So it's one of those contrarian investors that won't look good sometimes relative to the peer group, but over a long period of time, they have proven that they buy good stocks very cheaply and are very patient and have done a very nice job long term. You can see on Delafield that their long-term record 5 years is 12th percentile, but you can see this most recent quarter, 94th percentile. I said that when I first started talking this morning. That's a little misleading, right? And you can go back on Delafield through the most recent month through April, 62nd, 3 months 55th, and the 1 year they ranked 47th. So that number that's a very dangerous number of what their peer group rankings are. Stevens is on page 11. This is the group that Ryan Crane runs that is owned by the Stevens organization in Little Rock, Arkansas. Ryan Crane and his team was a lift out from AIM Investment Management in Houston. Doug and Tony were in Houston about 2 months ago and sat down with this team to really have a better understanding of how they're managing small cap growth. Their emphasis is nothing but quality, quality, quality. And so far in 2014, that's not been where the market's been rewarding investors, is in high quality small cap growth stocks. This quarter is kind of turned towards more high quality growth stocks. So we expect them to do a little better the second quarter and third quarter and the remainder of the year. Page 12 is Causeway. We've spoken to that. International exposure to terrific deployment. Very competitive group of managers, but I think I've spoken to the important parts of Causeway. Their primary strength is stock selection, stock selection, stock selection. Page 13 is the summary page, all the data which we've reviewed. Page 14 is just a review of what your contributions have been relative to appreciation, depreciation. You know this better than I, of how you have to continue to fund this animal. And then page 15 is very, very important. And I can look at any funds report and find flaws and errors and problems and concerns. But page 15 on the right-hand side, you take your whole portfolio, you roll it together in terms of the 5-year annualized return that's been experienced versus the standard deviation or the level of volatility of one manager to the other, and then the larger spot, the larger circle, of course, is the composite. So this is a nice deployment among risk and return, capitalization between Fayez, Seraphin, Dreyfus Appreciation, Stevens, with Delafield in the middle, and then the J.P. Morgan core bond portfolio. Page 16 does show your target versus actual, and Bob and staff and Doug and Tony have done a good job of keeping this close to target. The challenge funds like yours have and all clients is that suddenly you do real well in a part of the marketplace and you let that just float, right? When you're way ahead, you don't want to touch it. If you're over allocated towards an asset class, when you're winning, you don't want to readjust that. A key to success, of course, is readjusting to that right-hand target asset allocation unless it changes, right? So that's very, very important. Page 17 is a roll-up of all the equity exposure to statistically prove to ourselves and to you that we haven't created a big index fund. It's much different and should be significant, statistically different from what the market shows it to be. Otherwise, we should just get an index fund. So as you roll this together, it does differentiate itself from the market. Page 18 is a cumulative performance history of all these managers going back to 2009, January 1st of 2009. Had you invested $10,000, the results are displayed both graphically and numerically on the top of that page. Page 20 is the manager status. Even what we saw with the Dreyfus going to the first percentile, we think you should continue to keep the Dreyfus Appreciation on alert, which, again, as a public fiduciary, it's a terrific thing to have noted concern, observe, watch, monitor, and it shouldn't be an open-ended alert. It should be some point in time when you have to make a decision whether to take them off alert or go to more serious concern as a public fund. The others are in compliance. We do get a compliance statement from all these managers on a quarterly basis that they're in compliance with the Oklahoma City Opebt investment policy. Expenses are important on page 22. We want to continue to find ways to get the best managers at the lowest cost. That's kind of a conundrum in trying to accomplish that. And the only one, I'm not going to say it's high, but it's higher than the rest, of course, is the Stevens, 121 basis points. That's driven by the amount of assets you have, and as the fund grows beyond 30 million and gets 40, 50, those fees should go down eventually. The more you have, the better fee that you're going to get on these funds, and eventually some of it may turn into separate management, non-fund invested, and that could be cost-effective as well. Any questions?
I don't see a page 19.
What happened to it? 19. Well, I don't know. I'll blame Doug for that. I don't know. I'll find out. I don't have one either, so I guess we're good.
Yeah. But you don't know of anything that we're missing in that?
Other than Doug, no.
All right, any other questions? All right, thank you very much. Thank you, Greg, for being here.
Pleasure.
Appreciate it. All right, so can I get a motion to receive the monthly reports for March 31st and April 30th? All in favor? And then we have the presentation. The next item is acceptance of the interim financial statements for February 28th and March 31st. And Matt Boggs is here. Matt's an accounting manager in Accounting Services Division, and we also have Mitchell Massey, who is our accountant that works on the Opebt Trust and prepares financial statements. So Matt's going to present some information for us and talk a little bit about a change that was made in our financial statements.
Absolutely. I will spend the majority of my time in the 9 months ended March 31st for those financial statements. If we could turn to page 6, that is our statement of changes in planned net position. If you look at the very bottom, our ending balance for the 9 months was $33.5 million for the 9 months ended March 31st, 2014. That's up about $9.4 million if you compare that to the same 9 months for fiscal year 2013. If you look one line above that, our change in net position for this 9 months is $7.2 million. What that tells you of that $9.4 million change we have between last year and this year, about $2.1 million was related to those months between April and June 2013, and the rest would be the $7 million for these 9 months. Now, what makes up that amount, we can go up to the top section of our additions. Total contributions were $21.1 million, just about $600,000 less to the contributions for the same period for 2013. Investment income was up about $3.3 million at $5.078 million compared to $1.7 for the same time period in fiscal year 2013. So our total additions were $26.2 million. Of our deductions, we had about $18.9 million, and those are going to be the claims that were paid for the health, indemnity, dental, and life. Other administrative expenses were about $35,000, so our total deductions were $18.9 million. So that change in that position, that $7 million, comes from the $26 million in additions minus the $18.9 in deductions that we had. Where I'd like to kind of spend some time now is a different schedule we don't normally typically look at, but I thought it would be worthwhile this month. If you'd look to page 3 of your report. Page 3 gives us our changes in net position reconciliation. I will be the first to admit this was kind of a confusing schedule, and so what we did this month is we made some changes to it to, I feel, a little bit better tell the story of what's happening. If you really want to know the difference between this schedule right here and the schedule we were just looking at on page 6, the schedule on page 6 looks at it strictly from these were our additions, these were our deductions, this is what our net position changes. This one breaks it up by the different lines of business, if you will. If you just start from the top of the schedule, that was our 26.3 net position at the beginning of the year. Then it looks at it first by the HMO plan. That's a revenue neutral, so none of that change is going to be related to our HMO plan. Then with the indemnity plan, if you take that, it's going to take our employee premiums, the employer, the city's assessed premium, to give you your total assessed premium, minus the expenses related to the plan, which came out to be a $1.9 million loss. But you also have to factor in, if you go to the next line down, any excess employer contributions. Those were contributions above and beyond what would have been actuarially determined compared to what is happening in the plan, along with the investment income that we discussed earlier of $5.07 million and those administrative fees, gets you that change in that position of $7.2 million. So this schedule is in here just to give you the exact same information that we had on page 6, just looking at it in a little different way, and can maybe allow a little bit more of analysis and tell a little bit more of the complete story there. So we thought it was worthwhile to run through this report step by step, just so you could see it a little bit more and know that that tool is available to you. The final thing I'd like to point out, what we normally do, is on page 10. And as was discussed earlier with our target allocation percentages compared to the actual, we're pretty spot on with only a 0.1 difference for domestic, international, and fixed income. So that's all I had. If there were any questions, I can take those.
Do you have any questions on the financial statements? All right, thank you, Matt.
Thank you.
Could I get a motion to accept the financial statements for February 28, 2014 and through March 31, 2014? Second. All right. All in favor? Aye. Any opposed? All right, thank you very much. Do we have item 6 then is ratifying the claims listings? Can I get a motion? Second. All in favor? Aye. Any opposed? There's hesitation there, maybe nervous. Any reports or comments from the trustees? Any from staff? Any other interested parties? All right, with that, we are adjourned.